Hi, and welcome back to the Business Career College video series. In this particular video, what we're going to look at is the Registered Retirement Income Fund. This video probably only makes sense if you're watching this having also watched the full range of RRSP videos, or at least if you have an understanding of how funds get into an RRSP. So what I'm going to have here, I'm going to have a little scenario where we have Nick. Nick is 70 years old as of today. He's 70 years old, and today happens to be the 1st of April of 2013, and on this day he is 70 years old. Okay, you can insert your own April Fool's joke there if you like. So Nick at this point has, let's say, $190,000 sitting in his RRSP. Okay, and that's perfectly fine, nothing exceptional there at all. So what's going to happen though is that Nick is going to, doesn't really matter about the date, but let's say on the 15th of June of 2013, Nick turns 71. Now, it's likely that you recall the rule that says that you have to convert your RRSP into a RRIF or otherwise mature your RRSP by December 31st of the year that you turn 71. So let's say that we get to the end of the year here. That'll be December 31st of 2013. And on that date, Nick has actively made the decision to move his RRSP assets. And let's say over that time they've grown a little bit. This should be an invested amount and hopefully has grown. And let's say now he's got $200,000 sitting in there. So he's got $200,000 sitting in here. He could take it out as cash and deal with the full tax consequences. Probably not ideal with that amount of money sitting in that registered plan. Or he might alternately move it into an annuity and then have just a fixed income for the rest of his life. But for whatever reason, Nick prefers not to do that. He wants to continue to have it invested. So he chooses to move his money over to a RRIF. So he's now going to have the Registered Retirement Income Fund. He made that decision by December 31st of 2013, so no worries there. So now, as of January 1st of 2014, he has $200,000 sitting in a RRIF. And that triggers some calculations for Nick. A couple things we have to look at here. The first is, with $200,000 sitting in here, and him being age 71, as of this date, there is a schedule for RRIF withdrawals that starts at that age, at age 71. And it's an increasing schedule, so it starts off at a 7.38% calculation, meaning that at some point in the year 2014, and it's only that year, 2014, that applies here, he's going to have to pull $14,760 out of that RRIF. Now, he has a couple of choices here. His choices are he could take it out in regular installments, or he could take it out on January 1st. He could take it all in one lump sum. He could take it as a regular series of payments. He could wait until the end of the year and take it as a lump sum then. Whatever makes him happy and whatever works for him. Generally, people who don't need the funds out of their RRIF right away will wait until the end of the year because that gives you tax-deferred growth on that investment throughout the year. So he might actually wait until all the way over here at December 31st, he might actually even have a larger amount then. Let's say his investments continue to grow, and now he has $210,000 in there. Well, that's when he might make his decision to take that $14,760 out. You'll note that we're still using the amount that was calculated back here at January 1st. All RRIF calculations of this nature are done as at January 1st using the amount and age that you were on January 1st. So even though Nick is now age 72, that won't affect any RRIF calculations for this year. That'll affect his next year, his 2015 RRIF calculations. So he could do this. He would have $195,240 remaining in his RRIF. And a couple of notable features here is that on your minimum withdrawal, unlike a normal withdrawal from a registered plan, there is no withholding tax. So you'll have watched the video hopefully covering withholding tax from RRSPs, and you'll remember the 10, 20, and 30% withholding tax rates. That doesn't apply if he only takes the minimum. If he takes more than the minimum, there is withholding tax only on the amount in excess of the minimum. And if this was a spousal RRIF, that is, if Nick had built this RRSP because his spouse had contributed to a RRIF on his behalf, there will be no attribution either on the minimum. But any amount beyond that could create attribution back to his spouse if his spouse had contributed to an RRSP on his behalf. Now, once he's in a RRIF, there are no more contributions allowed, spousal or otherwise. There's nobody else putting money into a RRIF. There are still a couple of ways money can get into a RRIF. Generally, those are transfers from other registered plans as a result of, let's say, a divorce or the death of his spouse. But for the most part, we're really stuck here with no more contributions into that RRIF. So now let's say that Nick does happen to have a spouse. He has a spouse here, Tina. And Tina's a little bit younger. She is age 65. Okay? Well, the RRIF is sort of viewed as being both of theirs. It's not viewed really from a tax perspective as being Nick's exclusively. So what happens here is we can actually use Tina's age. It's our choice. It's Nick's choice which age to use, but he can use Tina's age to calculate his minimum RRIF withdrawal. However, because Tina's under 71, and the formula we saw up here, this table, this 7.38%, only applies starting at age 71, that doesn't work. So this is where we actually have a formula that we use. And the formula works like so. We would take the RRIF amount, that is Nick's RRIF amount, divided by 90. Nobody here is 90. 90 is just the formula, divided by 65. In this case, we're going to use Tina's age. You can choose to use Nick's age or Tina's age. If you use Nick's age, you're going to go with the 7.38%. If you use Tina's age, you're going to go with the formula. Once Tina is 71, 72, 73, she fits into the formula, and we would then use the formula age as we did up here. So let's say we do decide to use Tina's age. We would take the RRIF amount, again, $200,000. That amount as at January 1st, 2014, divided by 90 minus 65, that's $200,000, divided by 25. That will be an $8,000 minimum RRIF withdrawal from Nick's RRIF. So we'll now have an $8,000 minimum withdrawal. And that $8,000 minimum withdrawal again would have these same considerations. There would be no withholding tax and no attribution. Keep in mind that it's still taxable. Any dollar you take out of an RRSP is still going to be taxable. So don't lose sight of that. This is going to be taxable. Or if we choose the smaller amount down here, if we choose to use Tina's age, this amount is taxable, as would any amount taken beyond that. That's really all you have to worry about with respect to the RRIF. Basically, once you establish that RRIF, you just go through this same set of calculations every year. And again, every year you can choose whether to use Nick's age or Tina's age, and the specific circumstances might dictate. For example, if you know you want to take more out, you might use the older age because you're not going to have any withholding tax on that larger withdrawal. It's still taxable, but you can wait longer to deal with that tax burden that way. I hope that helps you to understand the RRIF. If you do have any questions, please feel free to let me know.